Hello everybody, this is Toni Turner and welcome to the market now as of about 1 p.m. Eastern on Friday, May 19th. Well, stocks were higher this morning as a set of strong corporate earnings lifted investor spirits in a week dominated by uncertainty. Wall Street's major indexes are on track for their worst weekly decline since mid-April. Investors are concerned that the uncertainty in Washington could hinder the administration's promise of fiscal stimulus. On the good news side, strong quarterly earnings from companies including Autodesk and Deere boosted the market. Of the 452 S&P 500 companies that have released results so far, about 75% have topped earnings expectations. In a typical quarter, about 64% beat earnings, so that's good news according to Thomson Reuters. Now let's go on to three charts that could give us some insight into the week to come. First of all, we're going to look at a daily chart of our S&P 500 SPDR, symbol SPY. This is the exchange-traded fund that closely follows our benchmark S&P 500 index. Now, as you all know, the SPY made a new all-time closing high on March 1st of $240.32. However, the intraday high has been beaten as on Tuesday, May 15th, the SPY made a new intraday high of $240.67. The closing high still holds, though, by a couple of cents. When I captured this chart today, the SPY was trading at $238.66. That's about $23.86 on the S&P 500 itself. Now, as you can see, the SPY is trading today, big exhale, back above its 50-day moving average, the green line on this screen, and is trading right now right at the 20-day moving average, the red line. Trading right at that, although the 20-day moving average looks like it has a little power here so far, excuse me, today to hold it down. Of course, our 50-day moving, our 200-day moving average, the black line, is rising underneath price, and that's a good thing. We can see here as well that after that March 1st high, the SPY slipped down below, down to its 50-day moving average, slipped down to this low of $231.61 right here, then made a slightly higher low at on April 13th to $232.51. So that's good. We're making slightly higher lows here. After that, the S&P moved back up to over its 50-day moving average, where it consolidated for a seemingly interminable time. Now, I told you I was being very cautious, and I certainly was, because when you see a consolidation like this, the bears are pushing down, they're selling. The bulls are pushing up, they're buying. Now, this forms a pressure cooker kind of effect, and we know that it's going to blow sooner or later. We just don't know which way. As it turned out, this past Wednesday, the SPY fell with the rest of the market, and it gapped down, making a low this day, this red day, at $235.70. But hey, this market is resilient. It bounced back up Thursday, closed right at its 50-day moving average, and Friday today, as I told you, it's back up over this line. Now, our question is here, that everyone has, I believe, is next week, in the coming week, can the SPY, and of course this S&P 500 is making the same moves, can the S&P 500 stay above its 50-day moving average? This is an important line of support is if price is trading over it, an important line of resistance if price is trading below it. So can the SPY maintain above this kind of intermediate term trend line, which is really what it is? Can it maintain above it and stay above it and maybe even break to new highs, or will it roll over and pressure markets a little over if it goes below the 50-day moving average. Now we do have support here, price support, right at about 232. So we will be watching that. That's pretty major. If the SPY breaks below that 232, then it could potentially head down toward its 200-day moving average. But we'll have to wait for next week to see what will take place. Our next chart today is a chart of the iShares Russell 2000 ETF, symbol IWM. As I've told you many times, the Russell 2000, which is the small cap index, this has the ability, or has shown to be able to move to be a leading indicator for the broader market, and its moves are closely watched when we're in kind of what I'm going to call a dicey market, and we really are in that right now. So we do watch this when we have questions as to where we think the market will go next. Now, when I captured this chart today, the IWM was trading at $136.30. These are small caps in the IWM. They're companies valued at $300 million to about $2 billion. Most of these companies are U.S.-centric, meaning that they do business in the United States. Now, we want to keep an eye on the IWM also, as U.S. company. The U.S. is about 25% of the world's economy. So I like to keep an eye on the IWM for that reason as well, as it is mainly just U.S. stocks and not the big caps that trade internationally. So again, when I captured this chart, it's trading at 136.30. Like its colleagues in the market, its indexes, it traded down, gapped down on Wednesday below its 50-day moving average. Now, it had an all-time closing high on April 26th, right back here, at $141.81. So that would be a nice resistance zone. Since then, it's really lagged the SPY and the NASDAQ, and again, it fell down this past Wednesday with the rest of the market below its 50-day moving average. But today, so far, it has not had the strength like the S&P has. It hasn't had the strength to move back above this resistance line. And this will be resistance. If you see this consolidation we talked about in the last couple of weeks, this consolidation here that walks right along the 50-day moving average, that was support, and that 50-day moving average was support. Now we have indicator resistance in the 50-day moving average. We have indicator resistance that is right here just above 136.30, and we have price resistance. So this tends to be when it starts moving up, people tend to say, hey, I bought it up here, I'm going to get out now while I can get out even. It's that kind of mentality, and that's what pushes the market down when we have resistance. So we will see here in the coming week, does the IWM have the ability, does it have the power, the buyers behind it, to move back up over its 50-day moving average, say over $136.50, or will it succumb to the bears and move back down toward this 133 line, which is very, very important key support, price support line right here. We really don't want to see the IWM move below 133. Okay, now for our last chart this week, we're going to look at the Select Sector Consumer Staples ETF. We've looked at this before, but it looks like it's in a place now where it could come in handy again. The Staples has 37 holdings. Some of the top holdings in this ETF are Procter & Gamble, Philip Morris, Coca-Cola, Walmart, PepsiCo, CVS, and everybody's favorite, Costco. The Staples as a group weigh in at 9.3% of the S&P 500 index. So it's certainly not a huge part of the S&P, but at times it's a very important one. Again, when I copied this chart today, the Staples were trading at $55 and 41 cents. It's been consolidating since last February, as you can see. While some other sectors like technology were moving higher, investors put money into those areas and other more glamorous sectors. When the market's moving higher, staples get ignored because they're just not very glamorous entities. Now, however, as we move into the summer months, if momentum stocks lose some of their mojo, staples may represent a less volatile, I should say, place to park funds. So we're looking at the XLP right now. Now the XLP made an all-time closing high on April 25th at $52.72. Now, so we're looking here to see if staples can break higher in the coming week and move up and out of this consolidation that they're in. And it appears as though they're trying to do so today. We can see that the 14-day RSI down here is neutral. We see what we expect with the MACD, that it's just moving along atop its zero line, as it would be because the XLP is also moving along its 50-day moving average. Now, this is a relatively low-risk position or trade. If in the coming week the XLP starts to move higher here, it may be an attractive long opportunity, but I say it's low risk because I'll only be interested in it as long as it stays above its 50-day moving average. So if it can move up and out, head toward 56 and new highs, I'm good with that. However, if for any reason it rolls over and falls below the 50-day moving average, a spot below that, say at 54.50, no lower would be my stop, my initial protective stop. And again, if the XLP moves below that, then I will not be interested. And if I'm in the trade, I will be out of the trade. So that is a real tight stop here, but that's the way I want to play this market, especially in this period of time. Okay, and now on to next week's economic reports. But first, please join us this coming Monday, May 22nd, for our next session of Toni's Market Club. We talk about indexes in Toni's Market Club, just as I've been talking about them with you today. We also talk about stocks and ETFs to trade, and I give you entries, protective stops, and profit targets, the whole trading plan, to help make you a smarter trader and so you can make more money. This is a low-priced, high-value opportunity to learn more about the market, become a smarter trader, and make more money. So please join us. For those who cannot attend our live session, not a problem. The recording of our session is available to all of our members just a few minutes after the session ends. For more information and to join, go to tonysmarketclub.com. And now, for the coming week's economic reports. On Tuesday, we have new home sales. On Wednesday, we have crude inventories. On Thursday, we have jobless claims and natural gas inventories. On Friday, we have durable orders, the GDP, which I'm sure will be scrutinized, and the Michigan Sentiment Report. Again, join us for Toni's Market Club this coming Monday. Don't miss out on this fantastic opportunity to raise your trading skills and your trading profits. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.